A monthly deposit hits your account. It feels like income, but part of the machine funding that deposit may be quietly selling away future upside while the share value underneath you sinks. That is the puzzle on today's table, a bond income ETF that has made money for an investor who held through every payment, yet has also lost a painful amount of capital on the screen. Both statements are true. The autopsy is about finding out which one matters more to you. Today we're dissecting the iShares High Yield Corporate Bond by Right Strategy ETF, ticker HYGW as of August 12, 2026. This is not a plain bond fund with a generous coupon. It is a fund of fund wrapped around a buy right index. In ordinary English, there is a high-yield corporate bond portfolio at the center and an options program laid over it. The fund passively tracks the SIBO HYG buy right index, which combines ownership of a broad high-yield bond ETF with calls written against those shares, so there are two engines in the same vehicle. The bond engine supplies credit exposure and interest income. The options engine sells some potential upside for cash today. That combination can create an attractive monthly stream, but it changes the ride. You are not simply lending to companies and collecting interest. You are also running a recurring trade around the bond portfolio with all the trade-offs that come with it. The fund launched on August 18, 2022. That timing matters because its entire public life has unfolded through changing interest rates, shifting credit sentiment, and different levels of market volatility. In other words, we are not looking at a strategy tested across every imaginable cycle. We are looking at a relatively young machine that has already encountered several meaningful stress points. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold any security. ETFs can lose value and distributions can change. Verify the current prospectus, holdings, distribution notices, tax documents, and other official fund materials for yourself, and consult a qualified professional who understands your circumstances before making any decision. Let's check the vitals. This is a fixed income ETF in the high-yield bond category, paying monthly with $112 million in assets under management. That is substantial enough to be a real fund, but not so large that size itself settles questions about trading quality, longevity, or investor demand. The expense ratio is 0.69%. That fee is charged for packaging the underlying bond exposure and the rules-based options overlay in one tradable product. Whether that is reasonable depends on what you expect the overlay to accomplish. If it produces useful cash flow and moderates the ride, the convenience may have value. If it mainly converts recoveries into distributions while the capital base struggles, the fee becomes another drag on a shrinking pool. Monthly frequency also deserves context. A monthly schedule is convenient for budgeting, but frequency is not quality. A fund can divide a strong economic return into monthly pieces, or it can send back cash while weakening underneath. The calendar tells you when the envelope arrives. It does not tell you where the money came from. The current run rate is 10%, based on annualizing the latest 4 payments. That is the honest lead number for someone evaluating the fund now because it asks a practical question. If the recent pattern repeats, what does today's buyer collect? The trailing 12-month yield is also 10%, so there is no stale, oversized historical headline creating a dramatic mismatch here. Recent cash flow and the full prior year currently point to the same rate, even though the individual payments have moved around. The mechanical annualized figure from the single latest payment is 8%. That latest distribution was 19 cents per share. This lower one-payment snapshot is a warning against treating any monthly check as a permanent salary. Options premiums vary with volatility, portfolio price movement, and the rules governing each option cycle. Bond income can vary as the portfolio changes. Fund managers can also distribute different mixtures of income, gains, and return of capital. A double-digit run rate is meaningful, but it is not a free bonus sitting on top of ordinary bond returns. It is a cash output setting produced by the whole structure. The useful question is not how big is the deposit. It is how much wealth remains after the machine creates it. Time for the history, and this is where the headline becomes less comfortable. The first 4 distributions averaged 64 cents per share. The latest 4 averaged 23 cents. The latest group is 36% of the initial group, so the direction is plainly down from those launch period payouts. That does not mean the fund will decline in a straight line from here. Option income is lumpy, and one month can differ from the next. But the longer comparison matters because it strips away the temptation to explain everything with one odd payment. The early checks established an expectation that the recent checks have not maintained. For an investor who built a spending plan around the opening pace, this is sequence risk in household form. The bills do not shrink just because the ETF's distribution does. A retiree may have to sell shares to fill the gap, and selling after capital weakness turns an income disappointment into a permanent reduction in share count. For a new buyer, the opposite mistake is anchoring on the old payments and imagining they are waiting to return. They might, but the evidence supplied here does not promise that. A responsible estimate begins with the recent run rate and then stress tests a lower outcome, rather than treating the launch period as normal. Now we examine net asset value, or NAV, the per-share value of what the fund owns after liabilities. The latest NAV and price are $28.89 versus a launch reference price of $39.60. NAV return since inception is negative 27%. That path matters because NAV is the soil from which future income has to grow. A smaller capital base has less value available to participate in recoveries, support future option trades, and compound. Cash distributions can soften the experience, but they do not erase what happened to the underlying share value. The maximum drawdown was negative 28%. For something filed mentally under bond income, that is a serious wound. High-yield debt carries equity-like risk when investors fear defaults or demand wider credit spreads. Interest rate changes can also move bond prices. Then the buy-right overlay alters the recovery profile. Premium can cushion some weakness, but written calls can surrender part of a rebound. Imagine credit markets panic and the underlying bond portfolio falls sharply. The call premium is a small shock absorber, not a force field. If markets then snap back, the options may limit how much of that rebound reaches the strategy. A path with a fast fall and fast recovery can therefore be especially awkward. The fund participates in much of the damage, receives some premium, and may not capture the full bounce. There is another distinction worth protecting. Market price is what buyers and sellers agree to on the exchange. NAV is the value of the portfolio. They can briefly differ, especially during stressed trading. Here the supplied latest figure places them together, but investors should still watch spreads and premiums or discounts when placing an order. A sound strategy can become a bad trade if entered carelessly. Here is the part that keeps this autopsy honest. Cash distributions since launch total $17.96 per share, and the simple distribution inclusive return since inception is 18%. So the investor who held throughout and counted every payment did not experience the same result as the price chart alone. The cash was real, and in this simple accounting it more than offset the capital decline. That deserves credit. Calling the entire strategy a loss would be inaccurate, but distribution inclusive return and personal outcome can diverge. An investor who spent every payment has cash utility but no compounding from reinvestment. Someone who reinvested bought more shares at varying prices and would have a path-dependent result. Someone who arrived late did not receive the early checks at all. Taxes, account type, bid-ask spreads, and reinvestment timing can further change what landed in the investor's pocket, though those details are not supplied here. This is why a payout chart and a price chart should never be judged in isolation. Total return is the scoreboard for wealth creation. Cash flow reliability is a separate scoreboard for spending needs. The strategy can post a positive result on the first while disappointing on the second, especially when the payment level falls substantially over time. A plain position in the underlying bond exposure would offer a different bargain. It would not deliberately sell calls each month, so it could retain more upside in a strong recovery. But it would also forego the option premium that can help during flat or mildly weak markets. The better choice depends less on which line has the flashier yield and more on which return pattern matches the investor's actual job for the money. Now let's open the machine. The fund uses a fund-of-fund approach. It holds shares of the iShares high-yield corporate bond ETF and writes one-month call options against them. The bond fund underneath owns a diversified basket of below-investment-grade corporate debt. Those borrowers pay higher interest because lenders accept more default and credit risk. The call writing side works like renting out part of the portfolio's upside for the next option cycle. A buyer pays a premium for the right to benefit above the call's agreed terms. The strategy collects that premium immediately. If the underlying shares stay flat, fall, or rise modestly, the premium can add income and provide a limited cushion. The options expire, and the process begins again. If the bond market rallies strongly, the bill comes due in opportunity cost. The calls gain value for the buyer, offsetting some portfolio appreciation. The strategy has effectively said, pay me now and you can have part of a powerful rebound. That is the central exchange, more cash today, less open-ended upside tomorrow. Why use one-month calls? Short cycles let the index reset repeatedly as market conditions change. They can harvest option premium often, but they also create repeated decision points where the fund trades away another slice of potential upside. When volatility is elevated, premiums are generally richer because protection and optionality are more valuable. Yet elevated volatility often arrives when the underlying credit market is under pressure. A larger premium may accompany a more dangerous environment, not a safer one. Consider three broad paths. In a sideways market, the overlay can look clever. The bond portfolio does little, interest accrues, and call premium adds cash. In a slow decline, the premium can soften losses but may not prevent them. In a forceful rally, the portfolio rises, but the written calls can make the strategy lag an uncovered position. What should investors watch from here? First, compare each new monthly payment with the recent cluster, not the launch memories. A single bounce is noise. A sustained sequence can show whether the cash engine is stabilizing. Second, track NAV alongside cumulative distributions. If cash keeps arriving while NAV continues to slide, ask whether total return is still advancing or whether the fund is merely changing the form in which value leaves the portfolio. Third, read the distribution notices and year-end tax characterization. Look for how much is attributed to income gains and return of capital. The label alone is not a verdict, but the pattern beside NAV tells a richer story. Fourth, watch credit conditions. Wider spreads, rising defaults, and stress among speculative-grade borrowers can overwhelm the limited option cushion. Conversely, a powerful credit rally can expose the cost of capped participation. Fifth, compare the strategy with an uncovered high-yield bond fund and with safer fixed-income choices. The right benchmark is not another product with an exciting payout. It is the simplest alternative capable of doing the same job in the portfolio. Finally, check current assets, trading spreads, fees, index rules, and fund documents before acting. Strategies and market conditions evolve. A diagnosis based on today's records should not become a permanent assumption. On life support, that verdict is not saying the fund has created no value. It has. The full holding period math remains positive when the cash is counted. The diagnosis comes from the quality and durability of that result. Severe capital damage underneath, a payment stream that has retreated sharply from its opening pace, and an options design that can blunt the very rebound needed to rebuild the base. This fund may still fit an investor who understands speculative-grade credit, values current cash over uncapped recovery, can tolerate unstable payments, and judges success by total return rather than by preserving the original share value. It is a poor fit for anyone treating the monthly deposit like a dependable bond coupon or assuming the quoted rate comes without a capital trade-off. The decisive question is not whether the fund can keep mailing cash. It is whether future cash, remaining capital, and foregone upside together compensate you for the risk. Until the distribution trend stabilizes and NAV stops doing the heavy lifting for the payout, this patient needs monitoring, not applause. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.